Right, let's talk about financial services now. Listen to this. It says here that worldwide the financial services industry is grappling with the severe stresses of a challenging economy, low interest rates, changing regulation, technological developments and pressure on reducing pay. And that's according to a report issued today by PwC. In the Johannesburg Power Lunch studio is Victor Bugutu, who is the Southern African insurance leader at PwC. Victor, thanks very much for joining us. These findings are not just confined to worldwide. We're talking about Africa here. You've just launched your Africa Financial Services Journal for 2013. Before we get into specifics, broadly speaking, what has the journal addressed?
The journal looks at the strategic and operational challenges facing financial services operators, not only in South Africa, but across the African continent. And that is against the background of what we've seen happening on the global stage and confirmed by our Global CEO survey, which was launched a couple of weeks ago.
The worldwide problems that I spoke about in my introduction, can they also be applied to Africa? Again, before we get into specifics, or are there certain challenges that Africa faces that the rest of the world doesn't?
We've got similar challenges. We've got talent challenges just like the rest of the world. We've got growth challenges just like the rest of the world. But having said that, there is opportunity for growth in Africa and Latin America and Southeast Asia, and slower growth in the developed economies, Europe and the US. The growth in Africa is purely riding on the basis of the opportunities presented by the lower penetration rates on financial services, and that's a huge opportunity.
Yes, indeed. I suppose when it comes to banking, there are people that are completely unbanked and even more that are underbanked. So as you say, it does present an opportunity, but also challenges. When you go to the banking and capital market sector of the journal, what did you find?
What we found that is the banks are re-looking at their business models, readjusting models on a risk basis to focus more on returning to the sort of returns on equities that we were seeing before the financial crisis. So that's the first focus area. The second focus area for banks is focusing on the customers themselves and re-looking at how they can retain customers as well as being operationally effective. So an expansion, if you like, of loyalty programs and those sort of things.
Yeah, that's something we've seen, of course, in South Africa, Victor. We've seen the big four banks traditionally dominating, but some upstart banks, or there used to be upstart banks, coming in. And because they focus so much on the customer, everyone's had to change. Is that throughout the continent the same case?
It's throughout the continent, but perhaps more so in our own country here in South Africa, where you've got these loyalty programs. You can see them across all the financial services areas, including insurance, medical schemes, and so on. So the focus on the customer is about retaining their lifetime value and selling as much to them as possible through their lifetime.
You talk about, let's get more technical now, you talk about ambitious ROE, return on equity targets, and you say banks need to be conscious of the possibility that although these actions may be rational at one level, you say, they may result in frustrating the intentions of policymakers and precipitate a fresh wave of intervention and regulation. And throughout your report, you talk about overregulation. Some people might say, Victor, that if the banks overseas had been overregulated, we wouldn't have had the subprime crisis and therefore the recession that we endured for so many years.
I think regulation is here to stay with us, and we need to find ways of dealing with it. The reason we have regulation is, first of all, to introduce or re-establish financial stability, prevent a recurrence of the financial crisis, and to restore public trust in financial services, in banking and insurance. So we need to embrace regulation. There is a journey to be traveled in regulation, and it's not all bad news. There are benefits to introducing a risk-based way of regulating the financial services sector. There are also benefits, operational benefits that come from a risk consciousness across financial services. So it's something that we have to embrace and work with.
Yeah, indeed, it's here to stay. Just before we leave that particular topic, do you think in certain cases we're going a little bit too far, or rather the regulators are going a little bit too far?
The regulators, I think, respond to what happens in the marketplace. The predominant and overriding principle is to protect consumers. And as I said earlier, to prevent a recurrence of the financial crisis. So there is a balance to be struck. If you look at South Africa in particular, we've got a Twin Peaks basis of regulation that is being introduced, which not only looks at the quantitative and prudential requirements, but also looks at protecting and regulating the market conduct activities of financial services providers to protect customers. So that is here to stay. The banks, the regulators want to protect customers.
Let's move on from banking now to insurance, which is, of course, your specialist field because you're Southern African insurance leader at PwC. Victor, you say that despite most insurers' optimism about revenue growth in the near term, most see the prospects for the overall economy as tentative at best. Now, this is quite a low figure. Only 15% of CEOs are optimistic, which is a bad number. Is that just South Africa? It can't be the rest of Africa, surely.
15% is a low number, but that's in the global context. As I said earlier, growth will be slower in the in the developed markets. But having said that, your emerging market economies in Latin America, Southeast Asia, and Africa are more positive about their growth prospects. And as I said, there is opportunity to penetrate the wealthier populations that we're now starting to see in Africa. So opportunities growing in the emerging markets and less growth in the developed markets.
Also, I suppose in the insurance industry, just like in the banking industry that we just alluded to, Victor, there are sort of new entrants to the insurance market. In the old days, there used to be these big behemoths that used to sit there and you used to go to them. But now, of course, you can go to a lot of other places. So, of course, competition has come to the fore.
Competition is there, but I mean, if you looked at our survey from last year of the local insurance industry, there is healthy competition in our marketplace. At the same time, there's innovation and opportunities for growth. So yes, there is competition, there are new entrants, but there are also areas for and opportunities for growth. Microinsurance is a good example where we need to penetrate the previously underserviced market areas. And there's legislation coming into place to try and stimulate and encourage that. So competition is there, but there's lots of opportunity in Africa. If you look at penetration rates across the continent, we've got low penetration rates as low as 4% in Nigeria relative to our own continent, our own 12% in South Africa. So there's opportunity to penetrate that gap and increase the service levels there.
We haven't got time to talk about the asset management side of your survey, but I would say that once people are banked and once they're insured and once a middle class emerges or continues to emerge in Africa, I would have thought asset management is going to be a startlingly compelling prospect in the future. Let's just wrap it up if we can, Victor, with the overall challenges. One thing we haven't spoken about for the financial services industry is the skills levels.
Yes, skills levels affect all areas across all the subsectors in financial services. And it's a recurring theme in asset management as well. But having said that, there's a lot of gearing up and retraining and reskilling that is taking place to take advantage of the new opportunities. But yes, all the CEOs were unanimous in pointing out the shortage of talent as a restraint to growth opportunities.